Now, as an improving US economy drove purchases of imported foreign goods higher, the trade deficit of the world's largest economy surged to a record $74.4 billion.
The announcement by the newly elected president sent tremors through international markets as his decision to impose tariffs on key trade partners became the catalyst for an unprecedented financial maneuver. The declaration was delivered with an unmistakable air of determination, setting the stage for a dramatic shift in global economic alignments. In response, a coalition of allied nations, long accustomed to the stability of US Treasury securities, initiated a coordinated sell-off amounting to $440 billion. This colossal movement was not merely a tactical financial decision, but a clear expression of discontent with policies that threatened the long-established framework of international trade and economic cooperation. Before we start, smash the like and subscribe buttons for more updates. The reverberations of this sell-off were felt immediately across the financial landscape. US Treasuries, once regarded as the epitome of safety in an unpredictable world, suddenly found themselves at the center of a crisis of confidence. For decades, these securities had symbolized the unassailable reliability of the US economy, providing a foundation upon which global financial stability was built. The decision by allied nations to divest from these instruments was a stark indication that even the most trusted assets were vulnerable when political decisions appeared to compromise the intricate balance of international economic relations. In the corridors of power and on the trading floors of major financial centers, the atmosphere was charged with a mixture of shock and apprehension. The implications of the Treasury sell-off extended far beyond immediate market reactions. They signified a seismic shift in the perception of risk and trust among nations. The move by allied governments was not simply about liquidating assets. It was a signal that the global community was reevaluating its long-standing assumptions about US economic leadership. The decision to unload a staggering $440 billion in treasuries underscored a profound loss of confidence in the stability and predictability that had long underpinned the US financial system. At the heart of the crisis was the symbolic weight carried by US Treasury bonds. These instruments had been a cornerstone of global finance, representing not only a secure investment, but also a manifestation of the economic might and reliability of the United States. The tariffs, announced in a politically charged environment, were perceived as a departure from the principles of open markets and mutual benefit that had guided international trade for generations. As allies reacted, their actions sent a clear message. Economic policies that deviated sharply from established norms would have far-reaching and destabilizing consequences. The mechanics of the sell-off itself were complex and multifaceted. Large institutional investors and sovereign wealth funds, which had traditionally held US Treasuries as a hedge against global uncertainty, began to reallocate their portfolios almost simultaneously. This sudden rebalancing of assets led to a sharp increase in yields as bond prices plummeted. Financial institutions scrambled to reassess the risk profiles of their holdings, while market analysts struggled to interpret the cascading effects of this massive divestment. The rapid liquidation of such a significant volume of treasuries disrupted not only the pricing mechanisms, but also the broader sentiment that had long ensured the smooth functioning of the credit markets. Central banks and government agencies were forced to confront the reality that the interdependence of modern economies was now under unprecedented strain. The move by allied nations was a direct challenge to the status quo, undermining the notion that US financial instruments were immune to the vagaries of geopolitical decisions. This event illustrated the inherent fragility of financial systems built on trust, where even minor deviations from expected policies could lead to outsized reactions. The sell-off was emblematic of a new era in which economic sovereignty and political strategy were inextricably linked, and where the consequences of policy decisions could no longer be contained within national borders. In the days leading up to the announcement, there had been whispers of a potential recalibration of trade policies, but few could have foreseen the magnitude of the reaction that would soon follow. The president's tariffs, designed to protect domestic industries and redress perceived trade imbalances, struck at the very heart of a globalized economic order. Allies whose economic strategies had relied heavily on stable and predictable trade relations with the United States viewed the tariffs as an act of economic aggression. This perception was further exacerbated by a sense that unilateral decisions, taken without consultation or coordination, risked igniting a chain reaction of retaliatory measures. The ensuing sell-off of Treasuries, therefore, was as much a defensive maneuver as it was a calculated effort to reassert economic independence in a rapidly shifting geopolitical landscape. The implications of this dramatic turn of events extend into the realms of international diplomacy and financial governance. The coordinated divestment from US Treasuries was a powerful demonstration of how economic tools can be deployed to signal disapproval and force a recalibration of power. By leveraging their financial assets, allied nations sent a clear message: trust, once broken, is difficult to restore. The move disrupted the conventional wisdom that had long placed the United States at the center of a stable, rule-based international economic system. Instead, it highlighted the vulnerability of even the most established institutions when confronted with aggressive and unpredictable policy shifts. In analyzing the broader impact of the Treasury sell-off, it becomes apparent that the event was not simply a reflection of market dynamics, but also a manifestation of deeper ideological divides. The president's tariffs were a manifestation of a populist economic agenda that prioritized domestic manufacturing and protectionism over the global free trade model. This shift in policy was seen as a repudiation of decades of international cooperation and a signal that the United States was moving towards a more insular economic stance. The response from allied nations, therefore, was not only about mitigating financial risk, but also about preserving the integrity of a global economic order that had long been characterized by interdependence and mutual support. The decision by allied governments to sell off such a substantial portion of US Treasuries highlighted the inherent risk associated with a financial system built on asymmetrical dependencies. The United States, despite its economic prowess, had come to rely on the continued confidence of its allies to finance its budget deficits and manage its national debt. The Treasury market, in this context, had been seen as a repository of trust, where the flow of capital was predicated on the expectation that the United States would honor its commitment. When that trust was abruptly undermined by a series of protectionist measures, the repercussions were immediate and severe. The sell-off revealed that the underlying strength of the U.S. economy was intricately linked to the confidence of international investors, a confidence that could evaporate in the face of disruptive policy choices. The magnitude of the financial disruption was compounded by the scale of the sell-off. A divestment of $440 billion represents not only a significant reordering of global portfolios, but also a stark demonstration of the financial clout wielded by allied nations. Such a vast movement of capital inevitably altered the dynamics of international bond markets, leading to a revaluation of risk and a re-examination of the fundamental principles that had long underpinned global finance. In many ways, the sell-off served as a litmus test for the resilience of the U.S. economic model. It exposed the vulnerabilities inherent in a system that, while robust in many respects, was not immune to the pressures of rapidly shifting political and economic paradigms. The interplay between political decision-making and market reactions has long been a subject of intense scrutiny, and this event provided a dramatic case study of how the two are inextricably linked. The president's decision to impose tariffs, while framed as a measure to protect domestic interests, inadvertently triggered a global reordering of financial priorities. Allied nations, with their deep-seated interests in maintaining economic stability, were compelled to reassess their exposure to U.S. assets. The resultant sell-off was not a spontaneous act of market panic, but a deliberate strategic response to a perceived erosion of trust. It underscored the fact that economic policies, particularly those that have far-reaching international implications, must be crafted with an acute awareness of their potential to unsettle the delicate equilibrium that sustains global financial markets. The immediate effects of the Treasury sell-off also highlighted the precarious nature of confidence in financial markets. The swift devaluation of U.S. Treasuries sent ripples through the investment community, triggering a reassessment of the relative safety of various asset classes. As yields surged in response to plummeting bond prices, investors were forced to confront the reality that even instruments once deemed as the ultimate safe haven could be rendered volatile in a climate of uncertainty. The episode served as a reminder that the stability of financial markets is not an inherent quality, but a fragile construct, maintained only through a continuous cycle of trust, reassurance, and mutually beneficial economic relations. Central to the unfolding drama was the symbolic and practical importance of alliances in the modern economic order. For years, the intricate network of financial ties between the United States and its allies had provided a buffer against economic shocks, reinforcing the notion that shared interests and coordinated policies could insulate nations from the full force of market volatility. The coordinated nature of the Treasury sell-off, however, revealed that these alliances could quickly transform from sources of stability to catalysts for disruption when the underlying trust was compromised. The move signaled a profound reconfiguration of global economic relations, suggesting that the willingness of allies to support one another was conditional upon a shared commitment to the principles of open markets and balanced trade. The implications for monetary policy were equally profound. The U.S. Federal Reserve, tasked with maintaining stability in the face of such unprecedented challenges, found itself confronting a scenario that defied conventional expectations. With bond yields on the rise and market volatility reaching levels unseen in recent history, the traditional tools of monetary policy were put to the test. The sell-off raised critical questions about the effectiveness of established mechanisms in managing the fallout from geopolitical decisions. It became clear that the conventional wisdom surrounding interest rates and liquidity management might need to be re-examined in light of a new era of financial uncertainty, where the interplay between political rhetoric and market behavior had become far more pronounced. At a deeper level, the event raised existential questions about the future trajectory of the U.S. economic model. For much of the post-war era, the United States had enjoyed an unchallenged position as the architect of global economic stability. The ability to issue debt in its own currency, underpinned by a robust network of international confidence, had allowed the country to pursue expansive fiscal policies with a degree of freedom that few other nations enjoyed. The dramatic sell-off of US Treasuries, however, called into question the sustainability of this model. The erosion of trust among key international partners suggested that the traditional advantages of US economic hegemony were no longer guaranteed. Instead, the episode underscored a growing awareness that economic leadership in the modern world required more than just financial muscle. It demanded a commitment to policies that resonated with the values and expectations of a global community. The political dimensions of this crisis were intricately woven into its economic fabric. The president's tariffs were emblematic of a broader shift towards protectionist policies, a move that resonated deeply with domestic constituencies but sent shockwaves through the corridors of international diplomacy. The tension between nationalistic economic priorities and the imperatives of global cooperation was brought into sharp focus, illustrating the delicate balance that must be struck between asserting sovereignty and maintaining the trust of international partners. The Treasury sell-off was a vivid manifestation of this tension, revealing how domestic political decisions could ripple outward and trigger profound shifts in the global financial landscape. Equally significant were the broader implications for international trade. The tariffs, which were intended to recalibrate the balance of trade and protect domestic industries, inadvertently ignited fears of a more fragmented and protectionist world order. The decision by allied nations to divest from US Treasuries was not simply a reaction to immediate financial concerns. It was a repudiation of a policy framework that many saw as antithetical to the principles of free trade and economic cooperation. This shift in sentiment threatened to undermine the intricate web of trade relationships that had long underpinned the global economy, raising the specter of a future where unilateral economic actions could lead to widespread disruption and uncertainty. In the realm of international finance, the event has prompted a profound reassessment of risk. The coordinated sell-off was a stark reminder that the safety and stability of even the most time-tested financial instruments could be compromised by shifts in political sentiment. Investors around the world were forced to confront the possibility that the foundations of modern finance were more tenuous than previously assumed. The episode underscored the importance of diversification and the need for a more nuanced understanding of the factors that underpin market stability. As the global community grappled with the implications of the sell-off, It became increasingly clear that the dynamics of risk were evolving in response to a rapidly changing geopolitical landscape. The interplay between fiscal policy and political strategy emerged as a central theme in this unfolding drama. The president's decision to implement tariffs was rooted in a broader vision of economic nationalism, one that sought to reassert American interest in a manner that challenged the existing global order. Yet this approach came with significant trade-offs, as it risked alienating key allies and undermining the very institutions that had long supported American economic dominance. The Treasury sell-off was a vivid illustration of these trade-offs in action, revealing the potential costs of a policy approach that prioritized short-term political gains over the long-term stability of the international financial system. This crisis also cast a spotlight on the mechanisms through which international financial institutions operate. The US Treasury market, which had long been viewed as a bastion of security and stability, was suddenly thrust into a state of flux. The rapid divestment by allied nations not only disrupted the market, but also raised questions about the robustness of the systems designed to manage sovereign debt. Financial regulators and policymakers were confronted with the stark reality that the interconnected nature of modern finance left no nation truly insulated from the shocks emanating from the actions of its partners. The event served as a powerful reminder that the global economic order is a delicate tapestry, where the unraveling of one thread can quickly lead to broader systemic vulnerabilities. At its core, the massive sell-off of US Treasuries was a manifestation of a deeper crisis of confidence. It exposed the fragility of an economic system that had long relied on the implicit trust between nations. The willingness of allied governments to relinquish their holdings was a clear indication that trust, once lost, is extraordinarily difficult to rebuild. This episode forced a reckoning with the notion that financial stability is predicated not merely on economic fundamentals, but on the collective belief in the enduring strength of a nation's policies and institutions. The dramatic nature of the sell-off underscored that in an era marked by rapid geopolitical shifts, the pillars of economic confidence could be shaken by a single policy decision. The far-reaching implications of this event have spurred intense debates among economists, policymakers, and market strategists. At the heart of these discussions is the recognition that the traditional paradigms of global finance are undergoing a profound transformation. The delicate balance that had allowed the United States to finance its deficits with relative ease was now being challenged by a recalibration of risk and trust on an international scale. This evolving landscape has compelled a re-examination of long-standing assumptions about the role of sovereign debt in maintaining economic stability. The Treasury sell-off emerged as a vivid case study, illustrating how shifts in political ideology and policy direction could precipitate a dramatic realignment of global financial priorities. The unfolding crisis has also highlighted the inherent tension between short-term political objectives and long-term economic stability. The president's decision to impose tariffs was driven by a desire to assert national sovereignty and protect domestic industries. Yet the ripple effects of that decision reverberated far beyond the borders of the United States. The coordinated divestment by allied nations was a potent reminder that, in a globally interconnected economy, policies that prioritize immediate gains can inadvertently trigger long-term disruptions. The intricate relationship between domestic political ambitions and the broader imperatives of economic stability was laid bare, forcing a critical reassessment of the strategies that guide national decision-making in an era of global uncertainty. In many respects, the episode has become emblematic of the broader challenges facing the international economic system in the modern era. The traditional assumptions that underpin the dominance of US Treasuries were suddenly called into question, as market participants grappled with the realization that trust and reliability were not immutable constants. The massive sell-off served as a wake-up call, revealing that even the most established institutions could be undermined by policy shifts that disrupted the delicate equilibrium of global finance. The resulting discourse has been one of introspection, as leaders and economists alike confront the implications of a rapidly changing geopolitical landscape where financial stability is increasingly contingent on the interplay between domestic policies and international sentiment. As the magnitude of the Treasury divestment became apparent, The event transcended the realm of financial analysis and took on broader cultural and political significance. It became a symbol of the challenges inherent in balancing national interests with the demands of global cooperation. The willingness of allied nations to sacrifice long-standing economic ties in response to unilateral policy decisions was a stark demonstration of the fragility of international alliances. It illuminated the reality that economic interdependence, while a source of strength in many respects, could also be a vulnerability when political strategies diverged from the principles that had long sustained a harmonious global order. If you liked this video, please give it a like and subscribe to our channel. Also, leave your comments below and tell us, what are your thoughts on the $440 billion Treasury sell-off? How will tariffs impact the economy? We want to hear from you. Thank you for watching and see you next time.